Hello, good day. Today, I'm going to show you how to calculate bond yield using Excel function. Understanding about bond yield is important. Instead, an understanding of any financial market must incorporate an appreciation of the functioning of the bond market as a vital source of liquidity. It is even true in today's financial markets more than ever before because of the central role that debt plays in virtually every facet of our modern financial markets. I truly hope you can gain significant insight from this video. This video is slightly longer than my usual video as I have created an example that is close to our current economic environment with low interest rate to stimulate growth. I use the same example throughout the calculation of current yield, simple yield, yield to maturity, and yield to call. Hopefully, you can have a better overview of the four yield measures and derive meaningful conclusion from the comparison. Financial modeling with Excel truly make the computation process faster, easier, and more interesting. Compared to the use of calculator or formula, it is a skill for every finance student to master. I hope you will spend time practicing the modeling on your own. Let's start our learning journey together. In this video, we will learn four types of yield measure. Let's go through them one by one. Par value is also known as face value, maturity value, or principal. Take note that although most corporate bonds are issued with a par value of 1,000, bonds are quoted as a percentage of par during trading. For example, a 1,000 par value bond quoted at 94.007 is priced at $940.07. First, let's learn about current yield. Current yield relates the annual dollar coupon interest to a bond's market price. It indicates the amount of current income a bond provides relative to its prevailing market price. Current yield gives an approximation of the bond's quick cash-on-cash return. How can we calculate current yield? You can make use of the formula shown in the slide to calculate current yield. Current yield is the bond's annual coupon payment divided by the bond price. The current yield measures only the cash income provided by the bond as a percentage of bond price and ignores any prospective capital gains or losses. Therefore, we are going to learn a second yield measure, the simple yield to maturity. The simple yield to maturity attempts to rectify the shortcomings of current yield measure by taking into account capital gains or losses. If you notice from the formula, there are two parts in the formula. The first part of the formula is a current yield measure. The second part of the formula is an adjustment to the change in bond price until year of maturity. The number of years is considered in the calculation to represent potential capital gains or losses until maturity. Let's take a look at this table. There are three bonds here with different market prices of 98, 100, and 102. The par value is 100. A bond traded below its par value is a discount bond. A bond traded above its par value is a premium bond. The annual coupon rate is 2.4%. For a discount bond, the annual coupon rate is lower than the current yield and simple yield to maturity. The opposite happens to premium bond, where the annual coupon rate is higher than the current yield and simple yield to maturity. A bond traded at par will have its coupon rate equal to the current yield and simple yield to maturity. I have a homework here for you. Practice calculating the answer for current yield and simple yield to maturity. using the formula that you have just learned. The final answers are listed to motivate you to try and to check your answer. Okay? I'm sure you can do it. Next, we are going to learn about the most widely used bond yield measure, the yield to maturity. Yield to maturity is also known as redemption yield or promised yield. Yield to maturity is a measure of rate of return that accounts for both coupon interest and the price increase or decrease over the bond's life. It tells bond investors the total rate of return that might be expected if they were to buy and hold the bond until maturity. Let's take a look at the formula. From the formula, the yield to maturity is the interest rate that makes the present value of a bond's future payments equal to its current price. So, a bond's yield to maturity is the internal rate of return on an investment in the bond. The yield to maturity can be calculated using various Excel functions. I have listed 4 methods here. Let's learn about the methods one by one. Take note that different methods may produce slightly different answers. We shall find out why this can happen. Let's use the same example to calculate the yield to maturity for 3 bonds. Assume the settlement date is 15 December 2020 and maturity date is 15 December 2030. The bond will mature in 10 years period. For the production of this video, I have written an example based on the current low interest environment worldwide. I hope this is relevant for your learning. Most textbooks are written in early 2000, where the interest rate level is much higher at that time. So, not to worry if you come across examples with higher interest rates. The concepts remain the same, ultimately. Let's learn how to use Excel to derive the yield to maturity. I'm going to demonstrate to you all the 4 methods to calculate yield to maturity. You can choose to use whichever way you like in future. As long as your principle is correct, you should be able to obtain the answer. First, let's use the Excel rate function. I will type equal RATE, open bracket, NPER refers to number of period, which is 10 years times 2, because there are 2 coupon payments per year, comma, PMT refers to semi-annual coupon, so we shall point 1.2, comma, present value is the negative of the market price. The cash flow is negative because it's a cash outflow. Investor pay money to buy the bond, comma, future value is the par value, 100, comma, type 0 for ordinary annuity as cash flow occurs at end of period, close bracket, enter, and here is the discount rate for semi-annual basis. I shall annualize the semi-annual discount rate. I shall type equal, open bracket, 1 plus semi-annual rate, close bracket, power of 2 minus 1. And this is the annual discount rate for the discount bond. I can drag the answer across. And we have the rest of the answer for the second bond and the third bond. Next, I will use the IRR method to calculate the yield to maturity. I'm going to type equal IRR, open bracket, highlight all the cash flow, close bracket, enter, and this is the semi-annual IRR. To obtain the annual IRR, I should type equal, open bracket, 1 plus the semi-annual rate, close bracket, power of 2 minus 1, And this is the annualized internal rate of return. This answer refers to the yield to maturity. I can also drag the answer across. So here we have the answer for all the three bonds. For discount bond, the yield to maturity is higher. For premium bond, the annualized yield to maturity is lower. Next, we will learn the third method. Let's calculate the yield to maturity using the Excel XIRR function. I'm going to type equal XIRR, open bracket, highlight the cash flow, comma, highlight the dates, close bracket, enter, and this answer is the yield to maturity. Next, I'm going to fix the reference cell for dates by typing the dollar sign. This is called string function. I want to fix the reference cell for dates, which is column A. Enter. Then I can put my cursor here and drag across to copy and paste the answer. So here are the answer for yield to maturity for all the three bonds. You can see that the reference cell for the dates are fixed. Finally, we shall learn the fourth method, the Excel yield function. This function is useful when we have a date. Let's try it. I'm going to type equal YIELD, open bracket, point the settlement date, which is 15 December 2020, comma, point the maturity date, comma, then the rate refers to annual coupon rate, which is 2.4%, comma, price refers to the market price per 100 pound value, comma. Next, we are going to have a redemption value, which is the pound value per 100 face value, comma, and frequency is 2 because there are 2 coupon interest payment per year, comma, and finally the basis is the day count basis to you. I select 1, close bracket, enter, and this is the yield to maturity. Next, I'm going to fix the reference cell for dates, for settlement dates, as well as maturity date by typing F4 to fix the reference cell. Then I can copy and paste the answer across by dragging the cursor to the right. And you have the answer for the bond traded at par and the premium bond. These three answers refers to the yield to maturity. In this slide, I provide a summary of the answers derived using the four Excel functions: rate, IRR, XIRR, and yield. I hope you will try the working on your own. Hopefully this video and the summary answer give you the motivation to try. Take note that the yields obtained from different formula are not the same. The yield function is somewhat more complicated than the XIRR function, but the yield function has the advantage that it does the accrued interest calculation automatically. From our calculation, did you notice the following relationship? A bond selling at discount has low coupon rate, so low that the coupon rate is lower than current yield, and current yield is lower than yield to maturity. On the other hand, a bond selling at premium has high coupon rate and therefore deserve a premium in pricing. A bond traded at par has its coupon rate equal to current yield equal to yield to maturity. A callable bond gives the issuer the right to retire the bond before maturity. Yield to call is the bond return over the period from settlement day to the call date. The price at which the bond may be called is referred to as the call price. Yield to call is calculated the same way as yield to maturity. Yield to call assumes that bondholder will receive the face value of the bond and possibly a call premium at the call date. Let's take a look at the formula. In the formula, M asterisk is not the maturity value. M asterisk is the call price. N asterisk is the number of periods until the assumed call date. How can we calculate the yield to call? The method is the same as yield to maturity, just that we need to adjust the information. The call price is 102. So I have added a row for call price. The call date is 3 years from now, so I have adjusted a row for number of years to call date. I have also adjusted the cash flow table. The last cash flow ends at 103.2, which is equal to the call price plus semi-annual coupon of 1.2. When we use the rates function in Excel, take note that the future value is the call price. The number of period is 3 times 2, which is 6 annual coupon payment. Here is how we use the IRR function. And here is how we use the XIRR function. You can refer to the highlighted cell. To use the yield function, take note that the maturity date is adjusted to the call date. The future value is the call price. And this set of answer is the final answer. I hope this will motivate you to try on your own. Finally, we have come to the end of this video. Thank you for watching this video. Please practice the examples given in the Excel spreadsheet as practice makes perfect. I hope to see you again. Bye.